Welcome to the Bogart Effect, a wealthy wisdom podcast. The following Bogart Effect podcast is intended for general information purposes only. The information discussed is no substitute for personalized investment advice from Bogart or another investment professional. Please see important disclosure information at the end of the presentation. Hello, today I got Patrick Marcinko with me, and we're going to be talking about restricted stock units. A lot of people call them RSUs. So Patrick, what are RSUs?
So RSUs are a form of equity compensation, primarily given from the employer to the employee. And it's an incentive for high performers, key employees at the company. And what they're promising is at some point in the future, now there's a vesting component that we can talk about, but they're going to give the employee X number of shares in the company. And so that effectively, at a simple level, is RSUs.
So real quick, you mentioned publicly traded companies, right? Mm-hmm. So do privately held companies have RSUs as well?
They do. So privately held companies can also issue RSUs. Now, there's different triggers that need to happen for those to come under control for the employees, and we can talk about that a little more. Publicly traded are, think about companies that are traded on the New York Stock Exchange. So when the vesting happens for those RSUs, the employees get stock that they could go sell, at the open market.
So for today's purpose, we're going to talk mostly about publicly traded companies.
Just publicly traded.
Okay.
Yep.
No problem. Just for our viewers, right?
Yep.
So let's get into, you gave us an overview. Mm-hmm. What are the nuances of RSUs, right?
Yep. So let's talk about, I think about RSUs from a key date perspective. Okay. So initially you have the grant date. That is either at the onset of joining a firm, or they can add as people progress and get promoted, you get granted. So let's say you're granted 100 shares. At that point in time, there's a promise in the future for the employee to get those 100 shares. At that point, there's no tax event though. Really nothing changes with the exception that the employee and employee have this agreement now that says in the future you're going to get them. No tax implications.
Give me some examples of what that means, right?
Yep. So let's say that your company comes to you and says, hey, you've been doing fantastic. In 3 years, we're going to give you 100 shares of X, Y, and Z Corporation, assuming you're still with the company, you're in good standing, all of those things, you're going to get 100 shares at that point. And so that is the grant date. So at grant, nothing changes. Well, then let's fast forward to year 3. Mm-hmm. You have 100 shares. When the vesting date happens, and it's a very specific date, it's not just, hey, at some point in the future, it's going to be a specific day. At that day, typically close of business, whatever the price is, times the number of shares, that's going to be your vested benefit. At that point, this is where taxes come due. Yep. And this is the fun part. So there's ordinary income, capital gains, taxed differently. Ordinary income is taxed according to higher tax brackets, a progressive tax bracket nature in the US versus capital gains. The full vested value, so again, shares times the price, that full value is going to be...
So let's make up some numbers, right?
Sure.
Let's say I'm giving you a grant today and it's at $10 a share. Mm-hmm. This is the grant date.
Yep.
And let's say it's a promise for 3 years from now, mm-hmm. you're going to get the shares. Mm-hmm. And let's say it goes from $10 to $30. Mm-hmm. So 100 shares I mm-hmm. granted to you when it was at 10, mm-hmm. right? So theoretically that would be worth $1,000, mm-hmm. right? Now, fast forward, let's say that 100 shares, mm-hmm. now 30, mm-hmm. right? So now that grant date, mm-hmm. it's $3,000 of mm-hmm. taxable event, right?
Mm-hmm. So that would be, that's the vesting price.
Correct.
And so at that point, you're pretty much getting, think about it this way, a $3,000 bonus for income taxes.
Yep.
So there's different ways that you can get it. You could either sell the stock same day, so you pretty much get cash, and then you can think about the RSUs as a cash bonus. You could have the company sell just a portion for taxes, so then you get a net amount. But at the end of the day, from the IRS's perspective, you got $3,000 of income.
So let's keep playing it out. Mm-hmm. Let's say, for example, I decided to pay the tax out of my own pocket, right? Mm-hmm. So $3,000 of ordinary income, mm-hmm. whatever my respective tax bracket is, mm-hmm. and then we keep the 100 shares, right? Because mm-hmm. I paid the tax bill separately.
Yep.
Let's say another 10 years goes by, and mm-hmm. now I decide to sell the shares at $50 a share, mm-hmm. right? Mm-hmm. What's the tax treatment then?
Great question. This is where it gets a little tricky. And so there comes what's called the holding period requirement. From the vest date, you pretty much reset everything. So at vest date, we have the ordinary income, pay your taxes that year, we're all set. From that point, there's going to be short-term or long-term capital gains treatment. The trigger for whether it's short-term versus long-term is going to be 12 months.
Great point.
In your example there, you're way over the 12 months. So you're now taxed more favorably, 15%, but it's not the full value. We go back to that initial $30 per share with the vesting. That's the new basis. And that's super important to track because we don't want to get taxed twice accidentally on taxes.
So what I'm hearing you say is, for all intents and purposes, the vesting date is the only date that actually matters. The grant date, it's nice to get it, but ultimately that's not triggering anything from a tax perspective, right? The grant date's kind of the feel-good day. Yeah.
That's where, hey, I'm the employee, I got this benefit coming, I can think about that as comp. But as you noted, no tax benefit, you can't sell, you can't access the funds, nothing happens at grant.
What if a dividend pays?
Great question. Dividends get tricky with RSUs, depending on how the company wants to treat them. So some companies will say, hey, you don't own the shares yet, you're not getting dividends. Other companies will pay out what's called a dividend equivalent. That's in the form of like a cash payment. That's going to be on your W-2. Some companies will give it to you, some companies won't. Hopefully yours pays it out.
But it's going to be based upon how the plan's established with that company.
Exactly. Right? Yeah. And that's, so going back to your question, or point about grant date. At the grant date, tax-wise, nothing happens, but that agreement has to be in place, whether how are dividends treated, what's the vesting schedule, all those things are set at the onset.
Interesting. So really, RSUs are just an incentivization for performance or some other metrics, could be a key hire element or ultimately incentivize you beyond that, right?
100%. And we think about it from, a lot of companies talk about buy-in from the standpoint of the employee and employer relationship. RSUs do represent ownership eventually in the company. And so, you could make an argument that, hey, by having RSUs, you're more aligning the employee and the employer, because the employee now, and you can certainly argue that they have a vested interest in the company because of their salary and career growth. But by having RSUs, you're financially one-to-one benefiting from the price going up. So
what are some caveats with RSUs? And ultimately, for somebody, for example, we work a lot with ExxonMobil, and a lot of employees are now getting RSUs that weren't previously getting them. So as we're trying to educate them ultimately on the value of this program and why it's so important to have it, let's talk about some of the caveats here, things to be mindful and awareness of.
Caveats. So there's a lot of stock options that we could talk about, and beyond kind of today's discussion with non-qualifieds, ISOs, things like that. RSUs, I would say, are the options that have the least amount of flexibility to the employee. So when we think about managing taxes, when we think about strategies to tax optimize, really income statements for families, RSUs don't give you any flexibility. That vesting date it's coming, you can't change it. I mean, I guess you could maybe say, I don't want the shares. No one's ever going to do that.
Of course.
So let's say the price in Exxon's example runs way up. If the payout is towards the end of the year, you may not know what income's going to be until that vesting date happens. It makes tax planning a little bit more tricky, but you're making more income. No one's going to complain about that. But the lack of control on when to exercise or any of that really limits the employee.
So glad you said that, because a lot of what we do at Bogart Wealth is tax optimization work, and you're exactly right. And we'll use the ExxonMobil example. Those pay in November, early December. That's fourth quarter, right? I mean, a lot of things can happen throughout the year, and when we're talking about tax management work and how to optimize the situation, we aren't going to know.
Right.
So let's use this in the case of a retiree, right? Because again, a lot of restricted stock, as long as you leave the company in good standing and honor the protocol, you're still going to get it, and it's still going to follow that respective vesting schedule. But for a retiree, how do we build that into a tax optimization case for them?
So great question. And so it really becomes a got to think about it carefully because the price can widely fluctuate. And we don't want to overly rely on RSU payouts at certain prices for cash flow because the vesting date is a drop dead date. If you get a bad month beforehand, it could change your cash flow plan.
Or a good month.
Or a good month. And the opposite could happen. And oh my gosh, I have more cash than I thought. And so when we think about cash flow, we have to be mindful of, are we over relying on this? Are we under relying? Are we accounting for it from taxes? Because a lot of people, depending on the income bracket, RSUs don't withhold enough. And why I say that is because most firms will hold 22%. For a lot of people, that's enough to cover taxes. But let's say that you're in a case where you're drawing from IRAs, you have a lot of ordinary income, you're pushing into those upper tax brackets. We now got to factor in to tax optimization. Where are the taxes going to come from? Where's the cash going to come from to have that liability in the springtime? So all of those things factor in, and it's one of those cash flow sources that has a little bit of uncertainty and really needs to be planned with the advisor and being touch basing, talking to the advisor frequently around that point to understand what is the game plan, has the game plan changed because of what the vesting price was, and so forth.
So you hit a couple things there. I want to pull on those threads a little bit, right? And I think about a retiree. Let's say, for example, we are depending upon them on cash flows. A lot of times I like to treat them as lagniappe, extra cushion, right? We have a cash flow strategy that's independent of the restricted stock, right? That way, because your point, you have a bad month, you don't want to liquidate, whatever, we can't have that be the sole driver for cash flow. But where my mind was going is, let's say, for example, we're using cash in a savings account, a money market account throughout the year. Estimated tax payments aren't really necessary because we have no taxable income. And then bam, all of a sudden Q4 comes in and that dramatically changes our taxable income for the year. So it's very appropriate to plan for those, but it can be a material variation within someone's long-term cash flow strategy. This really impacts retirees, I feel, but it could also impact somebody who's still working at the same time too. I think you mentioned a couple examples here, but 2022, we had a lot of customers that we were projecting them to be in lower tax brackets because the RSUs were going into the year at one price point. And then, the stock has a 100% performance year. So what we thought we were going to see or close to see, even with what we were projected to see, if we did things like Roth conversions in the beginning of the year, and then all of a sudden, fast forward, 6 months later, stock goes up another $30 a share, and next thing you know, you've had a material change. So for a lot of tax management work, I'm a big advocate for fourth quarter. We wait till fourth quarter. We want to manage appropriately there.
And on that point of, we talked about retirees, the impact it could have on cash flow. For those that are working, as you noted, it can change things too. Because you have folks who are doing, let's say you're doing traditional IRA contributions, Roth IRA contributions. Well, if you're doing direct to Roth and you're on the line of, hey, am I going to be able to contribute? Am I not? You have 100% year on your RSUs. All of a sudden, you went from I'm good to do direct to now I need to think about things like backdoor and other things like that. But if you don't know until November and you've already contributed, that can turn into an interesting situation from where income falls.
Let's just explain that one a little bit more, right?
Sure.
So the reason that you're bringing that up is in order to be able to do a Roth contribution, you have to be below a certain income threshold, and that threshold changes 100%. Each year. If you're over that income threshold, that Roth contribution is now disqualified, and you're no longer eligible to do it. The reason that matters is those RSUs could throw you up over that threshold, right? Now, in the scenario of if we're even on the cusp, a lot of times we like to do what's called a backdoor Roth contribution. And what that means is we put money into an IRA and immediately convert it to a Roth because it went into the IRA tax-free. On an after-tax basis, the conversion to the Roth is tax-free, assuming no 401k. I just wanted to explain that real quick.
And thank you.
Because one of the things we fall guilty of, we talked about this, is industry jargon. We just dive in. But it's important to kind of explain the nuances. The takeaway, though, I'm going to probably emphasize is we want to be doing a lot of these conversations and this tax management work around the time of the vest date. If it's fourth quarter, we need to do it fourth quarter. I have seen RSUs that pay in the first quarter. I've seen some that pay in the second quarter. Really, it's important to make sure that you're revisiting how the restricted stock impacts your overall plan, your overall strategy as you're going throughout the year.
Yep.
Another thing I found interesting, just as we look at RSUs in aggregate of a strategy, is RSUs are ordinary income. Right? So we'll play out the retiree scenario, but let's say, for example, you want to still do an IRA or a Roth IRA contribution for you or your spouse. Well, the restricted stock can qualify you from an ordinary income perspective, right? So I like that as another strategy in terms of, especially when we're trying to get as much as we can from IRAs over into Roth IRAs. I mean, that's kind of a general guidance point, is to continue to get money moved to Roths. But the restricted stock can be a way to help us trigger that, right? So what else do we need to talk about related to RSUs today? Anything from an optimization, other nuances we need to bring into consideration?
Yep, totally. And one thing is, I want to reemphasize, when the vesting happens, reviewing, and typically there's a statement that's given that shows if you do elect for shares to be withheld. So the way that would work is, okay, you vest at a certain price. Well, they'll withhold shares. So let's say you have 100 shares, they'll withhold 22 shares to account for taxes. Then in your brokerage account, you're net the amount after that. For folks that are above that 22% bracket, you can find yourself in a situation where you're under withheld on RSUs. And that opens up a conversation about, depending on when the RSUs vest, estimated tax payments and under withholding. And for those that may be caught off guard, it can lead to a surprise tax bill come springtime. And so looking at what is the withholding percent the company elected, some companies may allow you to withhold more. A lot will default to that 22%. And for some people, typically joint income households, they may be above that, and that's something to watch out for.
Fantastic point. And by the way, I'm going to add the dividends to that as well. Right.
Good
so
point.
if the company is allowing for dividend payments on the non-vested shares, well, those non-vested dividends are ordinary income as well. And it all gets factored into the math equation here, because those dividends are going to be reported on a W-2. Well, early on in the year, if you don't have a lot of other income, or if your income relative to the value of the RSUs is moderately low, that could be a huge surprise, right? So it's one of these where we continue to come back to this point of why tax management is so important, why having a plan and looking at these things is so important.
Yep.
So talk to me a little bit about, I've got a job offer coming in, and they're offering RSUs. What does that look like? How do I need to be factoring that into my decision making?
Great question. So RSUs are a big part of compensation. In today's world, I mean, when we're looking at what people are looking for in job offers, stock plans are becoming more and more asked for from employees looking for gigs. So let's take an example where salary is $80,000, that's the offer. But then they're going to give $20,000 of RSUs paid out over a 5-year vesting schedule. Well, at that point, you need to think about, what is my total compensation? Because salary isn't the only compensation. The RSUs factored in need to be included. But don't think about it in the context of, okay, my total compensation is going to be that plus the RSUs, because with vesting, you don't take control of the shares. You don't get the shares paid out until the vesting date. And so if you get $5,000 paid out in year one, total comp for the job may be $85,000. Well, that needs to be considered, because if you're considering a $90,000 position versus 80 plus 5,000 of RSUs, that
the gap's not as wide.
Is not as wide, right? And so that sort of vesting component, as well as the RSUs, are being added on to total comp. And so job offers need to be compared based on total comp, not just base salary.
Great point. Should I be looking for a job that just has RSUs as the incentive program? Are there other types of incentive programs that I might want to consider as I'm evaluating? So
RSUs are a great benefit. And I would say that it's going to depend on a multitude of different things. Certain companies, depending on where they are in their business model, RSUs may be more favorable than not. If you have a very mature company, the upside of the RSUs may not be as much as a smaller company that's really getting ready to explode growth-wise. And so if you're getting shares at a company that's in this hyper growth mode, that may be more valuable. It's hard to size that up and put a monetary value, but there is some thought in the back of your mind is, would I want to own these shares? Do I think that the company's going to do really well? What sort of benefit? And again, that's hard to quantify, but that's something to be considering. Then there's some other, forms of options, non-qualified options, ISOs. That really, dives into that private world where you have companies that are raising capital, raising equity in the firm. They're looking for that liquidity event, and that's a little different than public. And I know today we're talking about public, but there are a lot of different options. And so talking to your financial planner to fully understand, they say I'm getting 10 shares. Well, what does that mean? How is that going to be taxed? How does that fit in? Super important, because at the face level, an offer could look like one thing, but the way the RSUs or non-qualifieds are taxed or fit into the plan or vest, comp could drastically change.
100%. Now, let me ask you this question. Do RSUs create the potential risk of concentration in your portfolio?
Great point. So yes, they do. And I talked a little bit earlier about how to get the RSUs when you vest. So you could do, and let's talk about that first, and we'll come back to concentration. When you get RSUs, there's a couple.
Actually, let's take a step back. What is concentration? Right? Like,
great.
Why does it matter? Right? Because it's compensation that's coming in.
Yep.
But at the end of the day, some people might say, well, that's a risk. Some people might say it's not. What do we mean when we're talking about what is concentration?
Great question. Concentration, really think about it we talk about diversified portfolios, having a broad mix of investments. When you get RSUs, you're getting stock in one company. Yep. And when we think about things like the S&P 500, diversified portfolios, one company carries a lot of risk. When you think about the broader market, you could have, economic data, influence markets and things like that from a broad perspective, but you're not company dependent. With single stock, you become earnings to earnings dependent in terms of, what sort of events can derail the company. You have a biotech company, something happens in the R&D phase, you have a lot more risk within that position versus holding a basket of companies in a diversified portfolio. So concentration really applies to owning a single name or a couple names relative to a diversified portfolio. Yep. When you own single names, typically speaking, they're much more volatile. And think about concentration also in the framework of your whole financial situation. RSUs and company stock, well, if you're paid by that company, your salary and bonuses dependent on that, your career trajectory is dependent on that company. If something happens to that company, there's a lot of weight. 401k, yeah. Great point. There's a lot of weight on that company. You talked about some people may say, I love the company, I'm okay with that risk. Other people may say, I'm very happy with my firm, I think that it's going to be good, I just don't want all my eggs in one basket. So within concentration, that's really what we're talking about and thinking about.
And I guess, the reason I'm thinking of it, you get to this executive level where, yes, they're incentivized with new grants that ultimately that could start to skew their overall allocation in that one company. Of course, 401k, you think about your income, your salary, et cetera. Yep. But then you have this big portion of non-vested shares that you can't do anything with. Should we be considering that a part of their net worth? I would say yes, because as long as they stay in good standing, they're going to get it. However, it's a completely non-quantifiable value.
100%. And I think that when you think about the portfolio, there's even things about allocation that need to be factored in. If you're in a sector where, let's say, all of your RSUs are in, the healthcare sector, do you really want your portfolio, your diversified portfolio, 401k, do you want to be overweight healthcare? Well, when context of everything together, you're already way overweight healthcare. And so when we think about customized portfolios, that also factors in. And to your point, should they be included in an allocation thought process and framework? In my opinion, absolutely. Because you're going to see net worth changes based on the price of that single stock.
Both directions.
Both directions.
Yeah, absolutely.
100%.
So what I'm hearing is you need to have a plan, right? And the RSUs are part of that overall plan. They need to be factored in from a cash flow perspective. They need to be factored in from a risk perspective.
Yep.
They need to be factored in from a tax perspective. Anything else I'm missing here?
Those are the big ones.
Yeah.
And also, cash flow planning in terms of, education planning, life events in the short term and intermediate term, because you can turn around and sell all the RSUs and now you have a, pot of cash. We don't want to overly rely on that because we've talked about, the fluctuations in price. But as you think about if you haven't saved to, 529s very heavy, RSUs could be a way to make lump sum contributions to 529s or cash flow for education planning. It really can become both an intermediate term bucket for cash flow, but also, that long-term bucket as well.
What else today in the world of RSUs?
Great question. So RSUs, thinking about, we talked about offers, we talked about diversification. I think that that's one point to just revisit is thinking about the single stock risk and how to really assess that. That goes back to something we talk about a lot at Bogart, and that is risk tolerance and risk capacity. Both of those things are uniquely important and heavily personal to each individual. And when we think about having that concentrated position, the rule of thumbs will say 10 to 15% in employer stock, keep it, modest. Some people, even that may be too much.
Sure.
And working with an advisor to truly understand, at any point in time, we know single stocks can fluctuate widely. Is that going to keep you up at night? Is that going to be a cause for stress? And is that then a monetary trade-off that we need to really think about?
Or is that going to impact future goals?
100%.
Whether it be cash flow,
Yep.
whether it retirement date. I mean, there's a lot of ways that could impact someone. Yeah, absolutely.
Yeah. And so, I love to talk about the numbers, the math, the projections. There is a heavy emotional component here.
Sure.
And because you have a volatile asset like a single stock, that really needs to be discussed as, hey, if something were to go either up, down, how would you feel? How would that really change things for you? Would it change things for you? And every single family, every single person is going to have a different answer to that question.
Bingo. Patrick, thanks for the time today. Look forward to having you back.
Thank you.
Take care.
The previous podcast was intended for general information purposes only. The information discussed is no substitute for personalized investment advice from Bogart or another investment professional. Different types of investments involve varying degrees of risk, and it should not be assumed that the future performance of any specific investment, strategy, or service will be profitable, suitable, or successful. Bogart is not a law firm or accounting firm, and no portion of its services should be construed as legal or accounting advice. There is no guarantee a client will experience a certain level of results if Bogart is engaged. Our brochure describing services and fees can be found at www.bogartwealth.com.